Welcome to ICICI Direct. Today, we're going to tell all of viewers everything you want to know about the HDFC Developed World Indexes Fund or Fund NFO. This opens on the 17th of September and closes on 1st October. This unique product will help investors invest into developed markets and be part of the global action. Joining us today is Mr. Ashok Kanawala, Vice President Products and Distributor Alliances, HDFC AMC. Thank you, Ashok, for joining us today on the show. Ashok, you have a very exciting NFO, the HDFC Developed World Indexes Fund or funds. Can you tell our viewers a little bit more about why an investor needs to diversify and look at investing internationally?
Thanks, Amina, for this opportunity. So when you look to invest outside India, or for that matter, any home country, I would generally say there are 5 reasons one should be looking at. First is that every country has their own economic cycles.
Right.
And therefore you have some kind of single country exposures. So back in India also we saw in last couple of years that our economy was slightly degrowing. So you had your own economic cycle. So if you want to mitigate your single country exposure, you look to invest outside India. So you look to outside your home country. Secondly, you may have a home bias. That means you definitely will have a larger portion of your money invested in your home country. And that is what we have seen worldwide also. But one should always be mindful that there are companies outside your own country which are truly global in nature and are growing, are part of innovative companies. And therefore, you get a chance to be part of their global growth opportunities. So that is second reason. Third is that when you want to diversify and when you look at portfolios, what you should really be looking at, what is the level of correlation between two portfolios. If the correlation between two portfolios is meaningfully lower, that means it helps you mitigate the risk arising out of one particular portfolio. So that's one reason why you should be looking outside your own country also. Typically, when you talk about emerging markets, and especially when you look at India,
Right.
They have a typical history of currency depreciation against developed currencies or maybe USD or other currencies that you are part of developed markets. And therefore, to hedge against the currency depreciation, this also can be one of the opportunities which can be considered to invest outside India. And finally, fifthly, so there are a lot of global themes which are available worldwide, but are not available in your home country. For example, when we talk about India, suppose you talk about Tesla. It's an electric vehicle manufacturing company based out of US, and you don't have such meaningful companies in India. Now we are all going through pandemics, and there are vaccine manufacturers worldwide, and we don't have such listed company back in India. You have cloud computing companies there in the world, which we do not have back in India in terms of listed space. So there are certain themes which you can participate by investing globally, which are not generally available to you in your home country. And therefore, these are the 5 reasons that I can think of why you should be looking to invest outside your home country.
Right, you're right. Umpteen number of opportunities that lie outside, of course, our home country, but just help our viewers understand this better, right? In terms of allocation, what percentage of your portfolio should an investor be looking at when they're making that exposure internationally? And also, if you can help us understand, give me a sense rather of, what sort of liabilities, expenditures could this be used for? So if you've got, international trips coming up, you've got children who may potentially want to study abroad, could this be a product that will help you negate that currency risk?
Brilliant, Samina, you're actually right. So there are certain expenditures which you have to incur over a foreseeable future. Maybe what you rightly said, you want to undertake a foreign trip, or you may want to provide for your kids' education, which generally is 3-4 years. And we all know that if the currency continues to depreciate, your liability or cost of education continues to go up. To that extent, when you have a foreign currency product, it helps you insulate from the shock of the rupee depreciation or your currency depreciation. To that extent, yes, somebody can definitely take a look at such opportunities. And as to what percentage of allocation should go into it, in my opinion, of course, it depends upon, you need to sit with your advisor and understand your cash flow plans, etc. But generally, I would say, depending upon your risk tolerance, I would suggest anything between 5 to 20% is what one can look at while considering investing abroad.
Right. Ashok, also give me a brief update on your new fund offering. Let's talk specifically about the HDFC Developed World Indexes Fund of Funds. We've talked about why we need to diversify internationally, but tell us more about this one.
Right. So the name, as the suggests, HDFC Developed World Indexes Fund of Funds. So three things immediately become very clear, that it's a fund of fund structure. So there is no direct investing from our side, right? The underlying funds are also going to follow passive investing, so it's index investing. So there again, also no active management of funds is there. So the second thing. And third, our target geography is developed world. Right. So three things: developed world, index investing, and fund of fund structure. Now, what this fund is going to do is going to track MSCI World Index. Now, okay. MSCI World Index is one of the most popular indexes worldwide, largely followed by global investors. And just to brief our viewers, MSCI World Index is a representation of large and mid-cap companies from 23 countries. Now, for each country, this index covers 85% free float adjusted market capitalization. So whether you are a large country or a small country, it will cover at least 85% free float market capitalization of each country. And there are more than 1,500 stocks forming part of this index. And in terms of diversification also, it has exposure to 14 currencies. So it's not typically one currency like a dollar. It has exposure to 14 currencies. And in terms of index, it covers, or in terms of market capitalization of this index, it covers 50% of the world market cap. And in terms of this 23 country, it is roughly 56% of the global GDP. So in one single fund, you get an opportunity to take exposure to such a large geographical diversification.
Right. So this, I'm assuming, is sector diagnostic and market cap diagnostic, right?
Yes. So here, if you really see the construct of this index, so when you talk about, there are three diversification clearly visible. One is that when you break the world index into various geographic regions. So we have broken this world index into 5 geographic regions. One is Canada, USA on the North America side, then you have European countries, and then you have Japan, and then you have Asia Pacific ex-Japan. Now, so when we look at world index, roughly 67-68% gets allocated to US, around 19% goes to Europe, 7% goes to Japan, and 3%, roughly 3% each to Canada and Asia Pacific ex-Japan. So you have a first diversification by geography. When you look at the revenue model also, it's well spread out across the world because the underlying companies are truly global in nature, structure, and size, deriving revenues from all over the world. Just to give you an example, while 67-68% goes to US or 70% goes to US and Canada, put together, only 42% of the revenue comes from North America, which shows that these companies are truly global in nature. And in terms of sector weightages, the first sector is information technology, which is 22.5%, followed by healthcare, which is 13%, and then followed by financial, which is 13%, and followed by healthcare, which is also another roughly 13%. So these are much balanced representation as compared to when we look at Nifty 50 composition back in India, where the first sector itself is banking, financial, with roughly 30-35%. So in our opinion, it truly complements the Indian portfolio. Further, it also has a mixed match of, as I said, sector representation. It is a mixed match of IT companies, which are global in nature. We all know about Apple, Amazon, Facebook, which are growth investing, but there is also companies which are forming part of the value investing. So you also have a diversification by the style investing also. So various types of diversification you can think of is available in one single fund.
Right. Ashok, how do you see the correlation between our Nifty 50 and the MSCI World Index, which is the benchmark for your fund?
I said that the two parameters one should always look when you are looking for a diversification. One would be the area of correlation, and other also one which will be seen in terms of volatility.
Right.
That is a movement of the underlying index. So when we saw the correlationship between MSCI World Index and Nifty 50 across time period, 3, 5, 10, 20 years, what we noticed that the correlation is roughly in the range of 0.4, which is meaningfully of a lower degree. So we always suggest that when you say you want to diversify, if the correlation is high, that means what? You are both moving in the same direction, the same proportion.
Yeah.
And we don't want that. To have a meaningful diversification, if the correlation is of a lower degree, that means the movement will not be in the same proportion.
Right.
And that's what we actually saw in this index versus Nifty 50. Suppose in the crisis period, like 2008, when world index was down minus 40%, Nifty was roughly down 60%. Yeah. So that was much more volatile. And during the tapering time, when US started tapering the currency, I think around 12-13, world index was up and the Indian index was down. So it is actually showing a different type of behavior and therefore meaningful diversification. And finally, as I talked about volatility, what we saw that across time period, 1, 3, 5, 10, 20, 15 years, 7 years, whatever the time frame, what we noticed, the volatility of world index is of a lower degree as compared to Nifty 50. So people who are like looking for a more stable portfolio may consider this as an opportunity, because Nifty 50 part of emerging markets are likely to be more volatile as compared to developed markets or matured economies, and therefore are likely to be less volatile. So there are two things, correlation and a lower volatility, both on the lower side, I think makes a meaningful diversification for the Indian investors.
Diversification and stability, I think those are two important takeaways from that answer. Also, what type of investors do you think this fund is suitable for?
So, of course, I would say that people who are new to equity markets and new to mutual fund space, of course, you will not ask them to consider this kind of opportunity. But people who are already evolved, have been investing in Indian market, and today, Indian mutual fund industry is roughly 35-36 lakh crores. So you can say, and it has grown big in last couple of years. People can always, those who already have exposure to Indian market, can look to diversify outside India, as I said, in the ratio of in the percentage of 5 to 20% of their portfolio. So yes, people who are new to mutual fund space or first timers, maybe not the correct type to start, because you first would like to take exposure to your home country. When you have a significant exposure to your home country, then you look to diversify outside your home country.
Right. Ashok, can you share with us a brief update about your partner as well, Credit Suisse Asset Management?
Yes, Amina. So we are doing this product in partnership with Credit Suisse. Credit Suisse is a very large global asset management company with an asset under management of roughly over $500 billion. They have been in this business for last 80 years. And they offer various kinds of products, active, passive investing. Over 25 years, they started offering this passive investing. And the passive investing asset under management for them is roughly over $180 billion. And they have more than 570 such offering on the passive side worldwide. And more than 40% dedicated people are looking into this passive strategy. So they are very experienced. That track record of managing passive strategy is impeccable. What structure we are going to offer, the fund of fund, as I said, its underlying funds is already in existence, which Credit Suisse is offering to their their institutional investors worldwide, and we will be using their platform to offer Indian investors opportunity to invest outside. So these are some of the factors which we thought, and as I said, that eventually when you look to invest outside, you always look at a cost structure, which we found that it is meaningfully lower for this kind of fund, because it is a passive structure, and we have experience and expertise of our partners like Credit Suisse to manage the funds.
Wow, that's a great partnership with Credit Suisse Asset Management. Very lastly, Ashok, we've covered most of the important points, but any closing remarks?
Yeah, it's a very simple but an interesting investment opportunity. If I were to give you two things, it's your gateway to the development.
Yeah.
One fund takes care of every requirement that you can think of in terms of countries, in terms of currencies, in terms of regions, in terms of style. Everything that you can think of is covered in just one fund. So it's a gateway to the world of developed world. Instead of you looking to invest in bits and pieces in all those countries, it is one simple solution. So if you're looking for a global diversification, this is a one-stop solution. More importantly, if you look at the geographic profile of or a geopolitical profile of this fund, which you have on a far east side, you have Japan and SPAC, ex-Japan, and then you in center Europe, and then on the far west you have US and Canada. Therefore, you can say, the sun will never set on this fund. Some markets will always be open at some point in time, and therefore activity will always keep on happening. So, simply put, your gateway to the development.
You're absolutely correct. It is consolidated diversification opportunity for a retail investor. I think that's an important takeaway as well, right? You don't need very big money to be exposed or to take advantage of the global action. Best way to do it is through this fund, rather an NFO that is being launched by HDFC. The HDFC Developed World Indexes Fund of Funds, NFO. Thank you very much, Ashok. It was great talking to you today.
Thanks, Shamina. Thanks for this opportunity. And have a good day, viewers.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.